Good to have
Thank
you
you
back.
for having me back.
Earnings, is it part of the reason why you think we have some upside to go? They're not as bad as feared?
Listen, there's obviously a lot about which we all worry every day. The environment is as cloudy as it's been any time in the last 10 years. But I really think you need to think about the investment landscape built on 4 pillars, let's call it. First, the equity market, defined by the S&P 500, has effectively gone nowhere for the better part of a year and a half, call it. Obviously, there's been sector rotation underneath, but as a headline, that's been the case. And that's not really a topping pattern. That's generally a bottoming pattern. That's part one. Part two is earnings growth. Obviously, it's not good right now, but the base effect, which works against you right now, is going to start to work in your favor next year. Number 3, you have the Federal Reserve, which began cutting rates over the summer. As any economist will tell you, monetary policy operates with long and variable lags. So by the time you get into next year, you start having a little bit of a tailwind from that. And then fourth, you have what we'll call the wild cards. Maybe you get a trade deal, Brexit works in your favor, and some of those macro headwinds start to fade. And so based on those 4 things, if they start working in your favor, and I think they will, then the bias in that type of environment is still to the upside.
How do you think about, okay, maybe the Fed pauses? Maybe there's, false optimism out of trade. It doesn't come to fruition the way people think. Earnings don't recover meaningfully enough to carry the stock market higher. There's still slowing global growth to hold down the overall story.
Yeah, listen, we can shoot holes in that, and I can take the other side of it. But when you listen to what companies are saying right now, Thermo Fisher, 7% organic revenue growth. Procter & Gamble, same thing, both guided higher for next year. Costco, membership numbers are doing quite well. The home builders, Lennar and Pulte, talked about how the decline in interest rates is helping boost home ownership.
Sure. I could say Caterpillar's on the other side of that. And some other names too.
Texas Instruments and Textron and the like didn't do well. But I think to the point about maybe earnings aren't going to be as strong, that's right. I think bottom-up consensus is somewhere around 10%. I sell that all day. You'd probably be closer to 4 or 5%. If the Fed pauses, it's because things are doing okay, and that's ultimately going to be good for stocks. And while you can shoot holes in any argument one way or the other, to me, when you look at the totality of the evidence, so to speak, I don't know why we're on the verge of a recession such that you have a meaningful and sustained drop in stock prices.
Who wants in?
Asset prices.
Yeah, I mean, I think it's tough. We think that we're still at a crossroads. I'm not, confident enough to say that we are definitively, heading higher. We think it's still kind of in this muddle through where we could inflect, frankly, in either direction. And I think trade remains a big part of that, even though we don't want that to be the case. And we are kind of, marginally getting more optimistic on that front. But at the end of the day, there's still that unpredictability. We're watching 3 things. Stabilization of global data, which that we're not really there yet. It's a little bit more mixed. We might be finding a bottom, but I think it's still too early to say that. Resilience of the U.S. consumer. Again, some perhaps cracks there, but, for the most part, a strong consumer.
Some of these stocks that have done.